So, hello everybody. I hope everyone had a good New Year. And this is chapter 7. And what I want to do is basically go over some items with regard to efficient market hypothesis and rational expectations and calculating the price of a common stock. And we'll mention behavioral finance too. Many of you may be aware with the concept of behavioral finance, where people invest on and how their behavior is when they invest. So a lot of people don't know, and they'll just get information from their friend, and that's their logic in investing. Okay, so this equation is quite simple. You may have seen this already. If not, this basically is a one-period valuation model, how one would calculate the price of common stock. It's very basic, and it really doesn't truly work in real life. It's basically the dividend paid after 1 year, and if you sell the stock after one period. So, and you put, obviously, you put your required return in there, the equity required return. And there's a more generalized dividend model going out several periods, right? And you can see that here we're going out several periods. And it's shown this way, okay, as a summation of all the dividends you're going to receive, right? And if you're not going to, sell the stock for several years, the price, actually out to infinity, this price should be determined by the stream of dividends you're going to receive. So this is basically if you remember the present value formula from early days, if you've never seen it. And then you got the infamous Gordon growth model, which tries to fix some of the problems associated with those models. Sorry about that, but I need my coffee. And basically, it includes now the growth rate of the dividends if they're going to grow, but you have to know that in advance, obviously. And again, that's the only change here. So you plug that in. Notice how they change the next period's dividend from the original. So they just simply multiply this out and give you the dividend for the next period. All right. So how is stock prices really set in true life, right? The price is set by the buyer willing to pay the highest price, and the market price will be set by the buyer who can take best advantage of the asset, and we'll see an example of this, right? And if there's a lot of information about an asset, it'll increase its value, such that if Microsoft or Apple is coming out with a new product and there's advanced information and people are happy about that. Notice how real estate shot up when there was a hint that Amazon.com was moving along Island City, right? You saw what happened to the price of housing, so it was a similar effect. All right, so information is the key to anything, right? Any asset, right? If you have information about something, prices will change up or down, right? So if you're in the market, like me, you're constantly receiving information, and especially now with the economy, with all the stuff that's going on with China, North Korea, how stock prices are volatile these days. All right, so monetary policy has a role in all of this, right? Monetary policy is done by the Fed, and fiscal policy is done by the Treasury, right? First, when the Fed lowers interest rates, right, the returns on bonds decline, and investors are likely to accept a lower return and the price goes up, right? The inverse relationship. So you can see here the denominator is lower and it raises stock prices. Furthermore, a lowering of interest rates is likely to stimulate the economy, right? So we all know that's happening, right, after the big recession. So the growth rate in dividends is likely to be somewhat higher. So stock prices will go up, right? Which is, and we've had an 8 or 9 year growth market. So the infamous 2007 bear market kicked in, and there was a lot of extra uncertainty, so people demanded larger money. And the interest rates went up because of the uncertainty, and the stock prices dropped. Okay, so there's a couple theories here that we'll go through rather quickly. There's always argument about these theories. So the theory of rational expectations, and basically expectations are formed from past. So there are people are looking at the back end, the past. So people will end up using data, past data, to form their expectations. But some people actually look at other data too. So, it's not just looking at the back end, because that's not really the way to look at stocks, what happened in the past. Otherwise, we'd all be like living in the past. All right. So, basically, even though a rational expectation equals the optimal forecast, using all available information, a prediction based on it may not always be perfectly accurate, right? So even though you have the information, there may be something you're not seeing. So a best guess is not always accurate, right? It's because there may be some more relevant information going on there. So the theory has holes in it. And here's the formal state of the theory, right? Expectation of the variable that is being forecast, and optimal forecast using all available information. That's what they're basically hoping, that the expectation is based on all the information available from an optimal standpoint. All right, so there's basically incentives for basically equating the expectations with optimal forecast. People with better forecasts of the future basically tend to get rich, right? I mean, it doesn't always happen that way. All right, so basically, this theory of rational expectations, you're trying to be rational, right? And it's also known as the efficient market hypothesis, in that all the information available is given to you. All right, so if there's any kind of change, the expectations will the variable of form will change as well. So changes in the conduct of a monetary policy, like with the Federal Reserve, which they've been doing, and Trump has been going at it with the Fed lately. All right, so here's the efficient market hypothesis, and basically this is basically rational expectations in financial markets. So remember this equation, right? This is the growth of your share, right? This is the capital gains portion right here, and here's your dividend, right? All right, so at the beginning, we know PT and C. The price is unknown, the new price, and we have to basically come up with an expectation for this. You notice a little E there for an expectation. All right, so expectations. These expectations are equal to optimal forecast, and that's all we can do, forecast, right? With any information we have. So any current prices in a financial market are going to be set, right? So the optimal forecast of the securities return using all available information equals the securities equilibrium return. So in an efficient market with all the information available to you, right, a securities price fully reflects all available information, right? So, and that's the gist of this whole efficient market hypothesis. And I go through a little math here. And basically what they're talking about, unexploited profit opportunities being eliminated, and that's basically, I guess, arbitrage opportunities, right? All right. So if you look at information in newspapers and published and anything available to the public, and that's already right in the market prices because it's out there and it's available. So basically, what they're basically driving at is the evidence, for the most part, confirms that recommendations from investment advisors cannot help us outperform the general market. So if you want to give your money to somebody who says they're going to make you rich, you can go ahead and do that. But I've always steered away from those guys because the only guys getting rich from those guys are themselves because you're paying them a fee. So most likely, they're not going to help you outperform. They don't have crystal balls, if you know what I mean. So recommendations from investment advisors cannot help us, outperform the market. And here we are with behavioral finance, a hot tip, right? So don't get too involved with that. And like Warren Buffett says, and like I say, a buy and hold strategy is the most sensible strategy for the small investor. Over time, you make your money. And that's what I do. All right, so that's pretty much about it. Some of this stuff is just all right. So I just want to say something about behavioral finance here. All right, the lack of short selling, right? Basically, may be caused by loss aversion, right? People don't want to. Short selling is selling stock you don't own, right? Right, and a lot of times investors are overconfident. So bubbles like the .com bubble and the housing bubble, as you know, are usually based on overconfidence and social contagion. Eventually, housing prices are going to crash and all prices are going to crash. So I didn't invest in the .com boom because I thought it was bogus, and a lot of us got burned with the housing, but nothing we could do about that. So behavioral finance, you're making decisions probably without all the best information, and you're a little you got a lot of hubris, and you're overconfident about things that maybe you shouldn't be. Alrighty, so that's about it for chapter 7. Alrighty, talk to you later.